you do know a thing or two about risk. You write that math sets a speed limit on how fast a portfolio can compound. What is that math? Take us to Bell Labs and take us to 1956.
Thank you for having me, Carol. So this is John Kelly from Bell Labs, a physicist, also a fighter pilot and a bridge player, really fascinating guy. And he discovered that, most people assume that taking more risk means you increase the possibility of very good and very bad outcomes. But what he discovered is there's a limit. And beyond that, all you do is increase the probability of very bad outcomes. The Kelly point, and for those of you who are familiar with his work, probably in gambling context or investing context, the optimum is half of the Kelly limit. You go halfway to the cliff, and that's where you get your maximum growth. 439% under any reasonable economics, any analysis. We only have partial information about situational awareness. We have a 13F from April that doesn't have the shorts. We have, Wall Street trader chatter. But any reasonable suggestion says 439% meant they were well over the Kelly limit, meaning sooner or later you have this happen to you. You blow up. Could be years, could be tomorrow.
Aaron, the column's about situational awareness, but it's also about the time period that we're in. And you referenced what's happening in South Korea, and specifically with some of those levered ETFs and the chip names there. To you, does this illustrate sort of where we are in maybe a market cycle, a hype cycle? What does it tell you?
Well, I'm an AI bull myself, and I have some considerable investments in AI. Nothing we're talking about today would affect that, but having a long-term vision that AI is going to be very big doesn't give you a reason to take unlimited risk. And whether we're talking about South Korean retail investors, for that matter, New York retail investors, or the Situational Awareness Fund. You have to think about the long term. You have to think about, do I survive long enough to collect on my bets?
So I have a question for you. Investment folks, right, and companies often have, risk managers. And I understand, so
well, he's laughing right
am
now.
I wrong? Is there not someone to say, okay, you're in over your skis here? So what's your read on this firm? I mean, it's still a $10 billion hedge fund, so it's not like it's collapsed. And Citadel was happy to take, but we understand that that's what they do. But I don't know, how do we kind of step back here in terms of internally what this company is doing or this hedge fund is doing?
Well, okay, so Citadel has tremendous risk management, has some of the best risk management on the planet, which is why they're in a position to do this kind of thing. I don't know anybody at Situational Awareness, but the fact that they had either 4 or 7, I've seen different media reports, total financial professionals, makes me suspect, and plus their investments, make me suspect they did not have a risk manager or did not pay attention to him or did not have a qualified one, because it just does not seem like a risk managed portfolio. And all of the public statements we've heard from them only mention expected return, future outcomes. None of it mentions risk. So yes, they should have had a better risk manager. And that 10 billion that's pretty misleading. First of all, I think that they're still carrying Anthropic at 5 billion. I don't think they've marked it down at all from its peak, and it's certainly worth less than that. Second, they started the year at 1.5 billion, we think. They grew to well over, 10 billion. And so I suspect most of the investors in SA on a dollar basis have lost quite a bit of money. If you were in January, if you were part of that 1.5 billion, you're still up, I think, 30% for the year, Wall Street Journal reported. But most of the people got in closer to the peak and are probably well underwater today.
We're speaking with Aaron Brown, columnist for Bloomberg Opinion, former chief risk manager at AQR Capital Management, also the author of Wrong Number, How to Extract Truth from a Blizzard of Quantitative Disinformation. I like that you brought up that private stake in Anthropic, because I don't want to give the whole column away, but and I encourage everybody to go read it. I was just sending it around to some guests who've joined us in the past. You make the point that the Anthropic investment, it makes sense that they still have that, because they couldn't take margin on that. They can't transfer shares of that. So it's like at the end of the day, it's sort of the safest thing for them because they couldn't bet against it.
They can't lever it. There are people who will lend you money against it, but they won't. They're not daily margin, so you're not getting the kind of leverage they had on the public investments. And it's possible that they didn't lever it at all. My guess is they didn't. If you have public stock, you're going to lever those. You don't have to go to your private. But yes, a company like Situational Awareness, with their approach to the market, they should be making private investments and not levering them.
What about the banks that were lending the money? Like, what's the due diligence on that? And they were well-known banks. We keep citing like JP Morgan. I'm just curious how that typically works out.
Well, it typically works out like this one did. They get all their money back.
Yeah. Okay.
But
the due diligence ahead of it, Aaron, like, is there something that they look at ahead of it in terms of?
Sure.
Yeah.
Yes. They do that very carefully. And Archegos was, a couple of years ago, that was the exception. That was where they all got burned because they went ahead over their skis, as you put it. They went ahead. This is exactly how it is supposed to work. The banks always should do okay. And what they were looking at is they were looking at the market for this stock. They knew Citadel was around. They knew there were other people around who would, be in a position to buy on a dip, and they quickly got out, before they got hurt. And as I say, that's how it's supposed to work, and that's how it usually does work. That's why these companies are so big and rich.
But you also make the point in the piece that Citadel learned this lesson the hard way. Like, they're looked at right now as coming in and swooping in at this time, but post 2008, they suffered some serious losses.
And AQR in 2007 did as well. Yeah. So yes, risk management is a lot of unhappy experience, but learning from experience.
So hindsight is 2020. If this portfolio, and again, we don't have complete information, like you said, this is based around what has leaked in 13Fs, but what would have been the right way to build positions in companies that you believe in that wouldn't have overexposed them on the downside?
Well, okay, so situational awareness, the investment thesis is that AI is going to be gigantic, is going to, I won't say take over the world, but is going to be bigger than even most of the optimists think. But it has no thesis, at least as for many of the public statements, about the path to getting there. So you have to think about that through and say, what are the scenarios where we're right, but we don't get to keep our positions? It also has, I think people are not aware of how complex its positions are. Again, this is looking at the 13F without the shorts, but we can see they're betting against a lot of these companies. They're picking and choosing. And so they've got longs and shorts, and they've got a lot of puts on. So they're betting certain segments will do well and others are going to get beaten out. So this is a very complex bet. So you have to think, okay, what's the situation in which we're right, but what's the worst point between now and then, and can we survive it? It doesn't appear to me that they were asking that question, or they weren't, taking it seriously enough.
I want to wrap up with, you said earlier, Aaron, that you are an AI bull and you have positions. Situational awareness, we were trying to figure out, is this kind of maybe a coal in the canary mine when it comes to the AI trade and narrative? What would you say? It's not?
No, I don't think so. I mean, we had a pullback in AI and, a lot of people got hurt, but really the only headlines, disasters, are the people who were over levered, either the ETFs or situational awareness. Most of the investors are there for the long term. You don't see a huge sell-off. I don't see anybody changing their mind about AI. You had to expect. I mean, these stocks are extremely volatile, and the events of the summer have been, pretty much normal volatility for this sector. So if you were investing sensibly in AI, this summer was not an unpleasant experience for you.